Welcome to the Lord and Richards Show, a program that will enable you to become more financially independent and prosperous from a biblical point of view. Tune in each week to learn how to prosper through good markets and bad. Now, here's our co-hosts, Colin Richards, your biblical investment advisor, and Dylan Schoonover.
All right, welcome back to the show where he's Richards, inspired by the Lord, and this is the Lord and Richards Show. Colin Richards, CEO and founder, thank you for joining us today.
My pleasure, Dylan, and thank you for that lovely introduction.
Well, I try. We are talking taxes today, everybody's favorite, but really trying to mitigate it. You know, they say two things in life are certain, death and taxes. But that's not necessarily the case. There might be some strategies where we can help avoid some of those taxes, right?
Absolutely. Yeah, while it is certain we will pay taxes, we can control how much and when we pay those taxes.
So, going to that effect, the sweet spot, from my understanding, in retirement for retirees is really 55 to about 73 when RMDs hit, where there's a lot of things you can do potentially with the investments that you've accumulated to potentially mitigate those burdens. Is that right?
Yeah, it is. And let me define RMD because some of our listeners or viewers may not know that. It's called required minimum distributions. And if you can think of it as this way, the IRS has given you years to not pay taxes, and then suddenly they want you to withdraw your money when you hit 73, if you haven't already, and start paying taxes on that money. Doesn't sound fair, but it's the way the law works.
Yeah, it doesn't sound fair, but it doesn't sound fair that if you own your car, you still have to pay taxes on it either. I don't really understand that one.
Exactly.
But people spend decades, oftentimes going from say 20 to 60 or somewhere in that range of, saving. We're taught to save. And then all of a sudden it's like, well, now you're going to get taxed on it. And there's actually some better strategies that you have. Give us a little bit of insight on what you would do as opposed to just building up that money all of a sudden to be whacked with the tax buzzsaw.
Well, the dream scenario is if you start thinking this way early enough and work with an advisor like Lord and Richards that emphasizes reducing and eliminating taxes, the younger you are, the more you can do about this. My personal feeling, Dylan, is that the next generation is basically being mortgaged by the current generation. There's a cute little commercial that they had out years ago emphasizing this, where a man showed his little baby signing in crayon on the national debt. And what's happening is because not only the U.S. as a government, but also individuals are postponing, delaying into the future the tax issue, we're going to see that hit pretty hard. So if you're in your 20s, 30s, just starting to earn money, the time to start setting aside in tax-free vehicles is right now. But the good news is also, even if you're starting to approach retirement, getting into your 50s, early 60s, there's still time to move that money out of tax-deferred or taxable vehicles and into tax-free vehicles.
So you're saying the younger people want to blame it on the blame it on the boomers?
Yeah, and Gen X, my generation, we're spending everybody into oblivion and putting that tax burden off into the future. And I feel that tax rates are going up. My clients tell me that. I believe it as well.
The birth rates have anything to do with that? Obviously, if you go back to the 60s, average about 4 kids per household. Now we're seeing down about 2.4. How much of an impact does that have?
Well, it means with fewer people to shoulder the burden as a percentage of the population, we're going to see a greater burden on each individual.
Yeah, so there's going to be a time horizon there that could be a concern. But going back to those in or near retirement, which is predominantly what Lord Richards works with, what's some of the first things that stand out when you're looking at tax strategies for the retiree?
Well, the obvious one is the 401k and the IRA that most of us have saved diligently. We've done exactly what we were told to do. We had it taken out of our paycheck, so we didn't even have to think about it. But the problem is in those vehicles, which have, they serve a great purpose, but by deferring your taxes and always pushing them off into the future, when we start planning for retirement, we got to figure out, well, can we get these dollars into places where you can control when you pay the tax and how much tax you pay? And if we just leave those things in our IRAs and 401ks untouched with no strategy, the odds are you're going to pay too much and you're going to pay taxes when you really aren't convenient to do so.
Yeah, philosophically, is there a mindset problem where people just like to bury their head in their sand and go, well, if I don't look at it, it's not going to be a problem?
Sure, it's kind of like me with chores around the house, right? But I think that what's great is if you get an advisor, a coach, a colleague, and a counselor in your corner, like my team at Lord & Richards, we're going to help you take care of that, right? I love problems that I can just write a small check and somebody's going to take care of for me, right? I'm not a mechanic, so I pay people to take care of the car. Well, my brother is a do-it-yourselfer because he's got skill in that area. In most cases, people might have a little bit of skill in investing, but the area of planning for retirement can be a much bigger bite. And we recommend get a counseling team, a financial advisory team around you that will take the heavy lifting off, so it's not one of those tasks you just keep putting off forever.
Yeah, and I think whether you've got $700,000, $7 million, or anywhere in between, I think the amount you're paying to the IRS is still significant, right?
Yeah, it's your money, and so it's significant to you. Whether you're a multimillionaire or you're just a normal person who's worked hard for a living and want to retire, taxes are your biggest expense in life. And we are at Lord & Richards a firm that bases much of our advice on values that come right out of the Bible. And one of those is we're a steward of the resources that God gives us. We're not owners. God entrusts us with these resources to use for good in our lifetime. Why neglect this critical area where so much money could flow out of your portfolio that could have been used for good, but instead simply goes in the form of an IRS tax check?
Yeah, that's potentially talking about charitable gifting, which we can touch on in a minute. But I'm sort of thinking in my head, are you comparing the IRS to Zacchaeus, basically?
Well, he was a tax collector.
Seems like there might be a slight parallel there, potentially, although we don't know the religious affiliation of the IRS or not.
That's right.
So regarding that, charitable donations can be a strategy to mitigate some tax burden, right?
Yeah, absolutely. I find that the clients that are attracted to Lord & Richards are some of the most generous people that I've ever met. And most of them want to do good for others, starting with their own families. And one of the important things that you can do is make sure you plan well to leave money behind for your families that's tax-free. So you don't see them lose, or they don't lose half of that legacy. But while we're living and giving, the approach with charity is that you can not only use charity as a vehicle for doing good for others, but you can also do good for yourself by avoiding taxation on dollars that might otherwise have lost a third or half their value to taxes.
Sure, almost a use it or lose it scenario where you can then benefit somebody else or some charitable organization.
That's right. And when you mentioned earlier required minimum distributions, one of the neat things many of our clients will do is use what are called qualified charitable distributions. After they turn 73, the dollars go past your Schedule A on your tax return. So we already get pretty good standard deductions on our tax returns, and so a lot of people don't itemize, or maybe they don't give enough to charity to really increase your deductions beyond the standard. Well, in this case, those charitable deductions go on top of your standard deduction, in addition to. So we stack the benefit, get even greater deductions by sending the money straight from your retirement account to the charity. And so the IRS will allow you to basically bypass Schedule A, get an additional deduction that you wouldn't have gotten if you had taken the distribution first yourself.
Nice. We're getting creative and we're figuring out how to get the zero potentially legally within the tax structure.
That's right. There's always Switzerland and the Caymans, but that's for another time.
All right, when we come back from the break, we're going to talk about some things that are still taxable that you may not think in your investment portfolio.
You're watching the Lord & Richards Show, a program that can help you become more financially independent. Tune in to learn how you could become prosperous during good times and bad.
Just pick up the phone and give us a call at 720-372-0400. That's 720-372-0400 for your complimentary retirement freedom review. Or check us out online at lordandrichards.com.
Welcome back. I'm Dylan Schoonover, joined by Colin Richards, CEO and founder of Lord & Richards. And one of the common misconceptions that we were talking about taxes before the break is that, well, I've had to pay into Social Security all this time. Well, at least now I've got my full Social Security. But, potential red flag, sometimes your Social Security can end up being taxable, right?
Absolutely. And the problem is, as you said, most of us don't realize that. And so when we start to experience that as we withdraw our benefits in retirement, it can be a shock. It can greatly upset our plans because we don't get that whole check.
Yeah. What happens if, God forbid, somebody passes away, or in a better scenario, you put it all on black and you win a whole bunch of money, or you win the lottery? In that case, if you inherit or bring in a lot of money from somewhere, will that bump you up into a bracket where then your Social Security can be taxed?
Yeah, anything that you take in as income is going to be added together with 1/2 of your Social Security check to determine if your Social Security is going to be taxed. And the truth is, there's not a very high bar to hit that level. So at a lower bar, just several $1,000s of income, you can pay up to pay taxes on up to 50% of your Social Security benefit. And you hit that a little bit higher, for example, married couples filing jointly, you can earn about $48,000 between those two numbers. So half your Social Security check. Let's say your Social Security is $40,000 between you and your spouse. That's $20,000. It only gives you about $18,000 that you can earn without seeing your benefit taxed at 85%.
Wow. 85% sounds like the 40s again, right?
Yeah, well, that's not the tax rate. I apologize. That's the part of your check that they apply to taxation.
Got it. That's fair. What about pensions? Pensions can be taxed as well, right? And could potentially send you into higher tax situations.
Yeah, exactly right. Withdrawals from your portfolio. So you take that money out of your IRA, or you get money from a pension or rental income or inherited money that's still taxable like an IRA. All of those go to increase your Social Security taxation. And it almost sounds like it's impossible, but the truth is you can avoid taxing your Social Security if you get started early enough.
Yeah, so let's dive into that, because that's where Lord Richards becomes a solution, I believe. So how does your team put all that together? Because there's a lot going on there.
So there are multiple ways you can put money aside that you can withdraw later tax-free. I'll focus on just two pretty straightforward ones today. The one is called the Roth IRA. And since its invention, it's probably the most underutilized but most amazing tax resource most of us have readily at our disposal. It means that if you'll wait and pay taxes on the money you're going to set aside first, which means overruling your accountant and overruling your instincts to save money now, you will never be taxed on that money again if you follow the rules around a Roth IRA. And there's not that many, and it's easy to do. So that money will never again be taxed. But in addition, you can later on, if you made a decision to put money in tax-free or tax-deferred vehicles like IRAs and 401ks, you can convert that money, pay the taxes now, like we say on the seed when the money's a little bit less, and then not have to pay it on the harvest later. That strategy needs to be taken very carefully, because sometimes people will hear a program like this or read something, get all excited, oh, I'm going to convert my whole $1 million IRA, if they're blessed to have that, at once, and immediately shoot themselves in the highest bracket. What we want to do is actually very carefully, using software, wisdom, and planning, we want to only hit the lower brackets that we can achieve, not more than maybe the 22 or 24% bracket, pay taxes at a lower rate in order to make that conversion and never pay taxes again.
Makes a lot of sense. Were you a farmer in your past life? I've heard the seed and the harvest reference many times.
No, I wasn't. My family was, but I think it's an analogy that people can really get, right? I have a bag of seed or I have a whole field of wheat. Which one do you want to pay taxes on? Right? I'd rather pay taxes on the money before it grows and before the IRS and the government have a chance to raise rates.
Sure. Yeah, I like the idea of the Roth as well. It seems counterproductive maybe in the beginning, but then compounding interest over time that is not going to be taxed when you pull it out will probably feel a lot better when you get to your 60s or even 70s.
Yeah, two more analogies that my parents taught me growing up, right? No pain, no gain, right? So short-term pain, long-term gain.
That makes more sense, yeah.
Yep, absolutely. And the second concept that I learned growing up was eat my vegetables first, right? Let's get this out of the way so that later on in your retirement years, you're able to breathe a sigh of relief as you enjoy a tax-free retirement.
What was the vegetable that your mother was laying a stake in the ground with on you? What did you have to eat?
Oh, well, it was usually asparagus.
Is that why you have a disdain for it when you're in your older years?
Yes, exactly, right? Most of us have a vegetable like that.
Yeah, I think for me it might have been green peas. I was not a fan of those, and I just felt they just sat there the whole time. I couldn't get up from the table until I did it. But It developed character and discipline, right?
That's right.
So-
What doesn't kill you builds character.
Let's go with that. Doesn't kill you, makes you stronger, and unless it kills you, of course. So the widow's tax trap. Let's talk about that a little bit, because unfortunately, when a spouse passes away, there's some different tax situations that come into play that weren't there when you were a married couple.
And it's usually, once again, something that creeps up on people. They're not looking ahead. I've had people with kind of engineering, mathematical, scientific minds bring what they consider to be a complete plan, spreadsheets. They'll turn their computer around and say, what do you think about that?
Engineers,
we call them, yeah. And there's nothing wrong with that. I'm the same way, or I wouldn't be in the job I'm in. But the problem is we get thousands of opportunities to do this. With most people who are looking at their retirement, they get one. And you don't know what you might be missing. And I've had plans like that appear and they forgot to add inflation. Or they just taxed themselves in their spreadsheet at one rate throughout their entire lifetime. The truth is, it's much more complex than that. And when it comes to losing a spouse, we don't want to compound the emotional loss and the devastation of that with the sudden realization that we've lost a major portion of our Social Security income. And in spite of that, we've still moved into higher brackets because we've moved from maybe a married filing jointly favorable bracket to the less favorable, unfortunately, single brackets.
Right. Yeah, you get penalized essentially for losing your spouse, which is a tough deal.
Yeah, it lacks compassion. I think we need some reform in our tax system.
Well, I'm sure with the lack of gridlock going on in government, we should have no problem getting that moved.
Should breeze right through.
But one thing I think we should touch on, Colin, a little bit is the fact that it's important to look at these things from an intricate level. And a lot of times people, maybe they've been doing it themselves, listening to the show or watching the show, going, yeah, I've been doing this for my whole life or most of my life. But speak to the importance of why there's value in paying a financial expert like Lord & Richards to handle this.
Well, the truth is you don't even have to pay us for our planning. You know, one of the things that we believe is once you become a client at Lord & Richards, you deserve this planning at no additional cost to you. And so people ask us, well, then how do you get paid at Lord & Richards? Well, we charge a fee for the investment services we provide only. So whether it's detailed comprehensive tax planning, whether it's estate planning, we can actually bring that to you now at no cost to you. Or whether it's just the normal planning of getting to and through retirement, you don't have to pay a fee. But then when we dive in and we talk about things like Social Security, widow's taxation, all these things that can eat away, we have software and we have brains that we put together, and we've done this thousands of times, and we know not to forget to plan for singlehood. Right? Later in life, if we lose a spouse, we actually simulate that in your plan. We know not to forget to plan for the reality that 70% of Americans, if you're in a married household, one of you is going to experience what we call long-term care, which is an extremely expensive benefit that's not covered by the government and it's not covered by your normal insurance unless you get completely wiped out. We're not going to forget to modify your tax rates, your inflation. All of these issues in and of themselves are complex, but then you compound the complexity when you bring it together. We love it. We geek out about it, I like to tell people, so that you can be sitting on the beach, having a lovely time with your family, not worried about it.
Yeah, that's the way that every retirement should go, but unfortunately not the reality of how everyone does go. When we come back from the break, we've got one more bonus tip, one more bonus strategy that you may not have thought of in a way to mitigate your tax burden. We'll be back on the Lord & Richards Show.
Take the first step toward securing your financial future. Request an appointment today. Our team of experienced professionals at Lord & Richards is here to provide personalized guidance and strategies tailored to your unique needs. Visit us online at lordandrichards.com for your complimentary retirement freedom review. You're watching the Lord & Richards Show, a program that can help you become more financially independent. Tune in to learn how you could become prosperous during good times and bad.
Just pick up the phone and give us a call at 720-372-0400. That's 720-372-0400 for your complimentary retirement freedom review. Or check us out online at lordandrichards.com.
Welcome back to the show at Lord & Richards. We are so excited to be talking about this final segment, and I think it's one of the unsung victories or unsung heroes of your strategy that you have. There is another way to mitigate some tax burdens, and it has to do with life insurance. Is that right, Colin?
Yeah, man, you said the L word, Dylan, there.
I did.
Now, most people, when we think about life insurance, we're not thinking about, oh, this is my favorite investment category.
We're thinking about dying.
Yeah, they're thinking about death and the fact that somebody gets a death benefit off of your death. So usually when we think of life insurance, we're thinking about protecting those we love after we passed on. You know, we've lost our income as a result, somebody in the household has passed on, or we've got a mortgage to pay off. But in brief, life insurance can be used as an asset within your portfolio. It is most often used by ultra high net worth individuals. Which most people don't realize. They think, oh, life insurance, I just think of kind of a greasy salesman. But once again, this is the importance of working with a fiduciary and with certified financial planners. We view the entire universe of tools, and life insurance is one tool that can be brought in to meet several needs. We can protect the money that sits in a life policy. We can squeeze the fees down to the bare minimum to where you're often paying less in fees on a life insurance cash value policy than you would on an ordinary investment out there in the market. And here's the cool part, the money that sits in that policy grows throughout your lifetime or as long as you need it to, tax-free. And you can take it out tax-free as long as you follow the rules. And the interesting part is, although the rules are complex, as I've said about other things, this is something we at Lord & Richards geek out about, and we love to build plans that incorporate tax-free tools, including life insurance.
So let me understand if I'm correct, hearing this correctly. You can put the money in, it grows, and then you receive it out tax-free for your heirs.
That's correct.
That seems too good to be true.
Yeah, and I get that a lot. And so here's why it's not. So up front, at the beginning of a life insurance policy, your costs are the highest because the death benefit is often way more than what you've put in. And so what we do is we have the ability to squish down the size of that death benefit to the smallest amount allowed by law and still provide a tax-free cash accumulation. So there are very, very careful guidelines around that have been around for several decades. But if we do it properly, we're buying, in this case, a minimum of death benefit. There are other cases where you want that for a legacy and so forth. But in this case, we minimize that, take the cost down as low as we can go, and the costs only get smaller as a percentage as you go down the road. So typically, we suggest a shake and bake period, I call it, if you remember those old dishes.
Oh, yes.
About 10 years.
And I help.
Yeah, exactly. You were mama's helper, right? So about 10 years out before you seriously start to use that. But once you get to that point, whether you're in your 60s, 70s, whenever you choose to do this, you can add a tax-free stream of income alongside of Social Security that reduces or eliminates the taxes on Social Security as well. So not only is the investment tax-free, but now you've reduced or eliminated your taxes on your Social Security benefit.
Wow, that's pretty good. And how would the team go about setting up a time to be, or how would someone go about setting up a time to talk with the team about that?
The great part is whether you're going to meet with us online or whether you're going to come into our offices, we're going to have an amazing conversation. Once you reach out to us by phone or check us out on lordandrichards.com, our wonderful team is going to surround you with love, care, and we're going to have a great visit with you that you get the opportunity to express, Colin or team member, these are the things that are most important to me. These are the people that I love. These are the things I want to do. Now, you said on the radio or you said on your podcast or YouTube, you can get rid of my taxes. Show me how to do that, right? And our team will take it from there.
Man, that sounds like a win, especially because I don't think that's being talked about enough in the industry as a utilization strategy. My follow-up question to that is, do you win more if you live longer, or is it better to die sooner?
Well, it depends on who you are, right? I always tell people, when it comes to life insurance, I'd rather be the beneficiary than the insured, right? I'd rather be the guy that gets the check. And you know, although we're making light of it, the truth is that I have seen people compound their family wealth through a little bit of advanced planning and then be able to get a ball rolling that passes from generation to generation. This tool we're talking about, life insurance, some people disparage it, but it is one of the most efficient ways to pass money from one generation to another. So even if we're not talking about the tax-free benefits in your life, you can pass this on to family and continue the legacy that you've already started. And in my family, that's a legacy of trying to do good for people all around the world. We have a foundation. We use that foundation to do good for some of the most neglected and ignored people in the world, especially in Asia, places like Myanmar and India. And if that's the heartbeat of your family, and many of my clients have that, this is one of the most amazing strategies you can implement to keep that going for multiple generations.
Yeah, well, Colin, thank you for sharing your insight and your heart on this exciting topic of taxes, but it did bring out a lot of things that we would not have expected otherwise. And we thank you for joining us on the Lord and Richards Show. We'll be back very soon for another episode. Until then, you can contact us at lordandrichards.com or by giving us a call.
Just pick up the phone and give us a call at 720-372-0400. That's 720-372-0400 for your complimentary retirement freedom review. Or check us out online at lordandrichards.com.
Take the first step toward securing your financial future. Request an appointment today. Whether you're planning for retirement, managing your wealth, or optimizing your business finances, we're ready to help you achieve your goals. Visit us online at lordandrichards.com for your complimentary retirement freedom review. Investment advisory services offered through Lord and Richards Wealth Management, a registered investment advisor.